This week on Wealth Track, why bond manager Marilyn Cohen believes the great 30-year bull market in bonds is about to come to a violent end. The author of Surviving the Bond Bear Market, Bondland's Nuclear Winter, discusses strategies to protect principal and income next on Consuelo Mac Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Research affiliates, an efficient index for an inefficient market. Wintergreen, your home for global value. Rosalind P. Walter, and the Dreamin' Foundation.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mac. Is the great bond bull market of the past 30 years on its last legs? Look around the globe and you will see mounting evidence that interest rates are going higher and bond prices lower. Central banks around the world are raising interest rates to tame inflationary pressures. This week, the European Central Bank raised its benchmark short-term lending rate for the first time since the pre-financial crisis days of 2008. The 0.25% hike takes it from a record low of 1%, where it's been since May of 2009. Brazil, India, and China have been hiking rates for months to cool off their economies. The People's Bank of China just raised its one-year lending rate again to 6.31%, the fourth increase in 6 months. Now, here in the U.S., the Federal Reserve has kept short-term rates at record lows of near zero since December of 2008. But the debate between the so-called inflation doves, led by Fed Chairman Ben Bernanke, who favors low rates to stimulate the economy, and the inflation hawks who advocate raising rates to curb inflation, is heating up. This week, Mr. Bernanke reiterated his contention that recent increases in commodity prices, such as oil and grains, are likely to be transitory, while other Fed officials, including some voting members of the policy-setting Federal Open Market Committee, warned publicly about building inflationary pressures. A few even mentioned the possibility of raising interest rates later this year. Most Wall Street forecasts call for any rate hikes to begin next year. Well, when you're in the thick of it, it is hard to realize what an extraordinary ride in interest rates, both short and long term, that we have had. But thanks to a chart created by independent research firm Bianco Research, you can see just how extended the trends of first rising and then falling rates have been. Starting in the 1940s, rates on long-term U.S. Treasuries have gone from a low of just over 2% in 1946 to a high of a little more than 14% in 1981, 4 decades later. Now, since then, it's been a long 3-decade descent to today's still low levels on the 10-year note of around 3.5%. As Bianco Research points out, trends in long-term interest rates often last for decades. In the last 2 centuries, the shortest trend was a 20-year rise in rates from 1900 to 1920, and the longest was a drop in rates that lasted for 58 years from 1842 to 1900. Well, how long the next interest rate cycle will last is anyone's guess. Long-term rates in the U.S. have already started to pick up. The Fed is keeping short-term rates low for now. So according to this week's guest, we are facing a serious bond bear market. She is Marilyn Cohen, the CEO of Envision Capital Management, where she oversees more than $325 million in fixed income investments for individuals. She is also the co-author of a new book called Surviving the Bond Bear Market, Bondland's Nuclear Winter. I began by asking Cohen why she thinks the great bond bull market of the last 30 years is about to end.
I think it's going to end because the government is going to cease and desist its quantitative easing too. Interest rates are going to go up because inflation Real inflation is out there. I don't care what the anti-inflationists are saying. They need to go grocery shopping and fill up their car soon.
Including Ben Bernanke, I might add,
Absolutely.
who says inflation is not a problem.
Exactly. The dollar is down. You are seeing all the major central banks of the world either hold interest rates steady, increase interest rates, or increase bank reserves. And so, Consuelo, I don't think we're the smartest guys in the room anymore. We are behind the curve, and the curve is higher interest rates no matter what kind of capacity utilization is going on, no matter what kind of unemployment we have. It is baked in the cake.
One of the things that could keep the great bond bull market going is the fact, let's say Europe, they are tightening. They are imposing pretty serious fiscal restraints as well. The emerging markets are tightening. They want to slow their economy down. We have Japan, which might go into a double-dip recession. So there are things out there that actually could slow this global growth engine of the world and actually keep a damper on interest rates, right? Possibility?
That's right, but the 800-pound gorilla is our federal deficit, and that is huge. That is going to cause the bond vigilantes, once they're finished with the Eurozone, to say, okay, US, it's your turn. If you don't get your fiscal house in order, and everybody's talking about the deficit, but nobody's doing anything about it. If you don't do it, we, the bond market vigilantes, will. And I think that will be the flashpoint, because we cannot keep borrowing from everybody. We can't keep bailing everybody out and still think that we're going to be able to keep issuing treasuries at such low yields. That's not the way the script is going to go.
So you're essentially saying that the global marketplace and the people who buy our treasuries, including the Chinese and the Japanese, they're going to say that we demand higher payments to basically to lend you money.
Absolutely.
Right.
And the Japanese are going to have to repatriate a lot of their money in order to rebuild. And the Chinese have been ever so gentlemanly about what they think, but it's all, beneath the surface. And that is, they are trying to massively build up a middle class, doing a good job at it. They will not, once they get to that point, have to recycle their balance of surplus payments into treasuries. And why, if you're a central banker in Japan or in China, do you want to keep buying treasuries and see the currency depreciate? That is a no-win situation, and I think it's going to catch up to us.
So how long do you think this transition, again, from the bond bull market to a bear market, which is what you talk about in your new book, how long could this transition last, number one, and what do we do in the meantime during this transition from bull to bear?
Well, I think the bear has already started. It's just not a bear a la 1981 or 1994. I think the bear market started.
Where are you seeing it? What's most vulnerable?
I think it started the day after the elections, the day quantitative easing 2 was announced by Ben Bernanke. Everybody looked up and said, oh my gosh, they're printing money. The United States is printing money again. This is going to be inflationary, right? This is going to debase the dollar, right again. And I think that was the inflection point. Now, the real question is this going to be a bullet train bull market, or is it going to be a local? And I say a local because at that time, in November of 2010, the 10-year Treasury was right around 2.35%. It went up to 3.5%, then we've had a flight to quality because of Japan, et cetera, back down to maybe 3.35%. That doesn't sound like a lot, but if you own 10-year bonds, you're down 10 to 12 points. That's a lot of dollar points. And I think that's the way this bear market is going, out of the bull into the bear phase. That is, rates move up a little bit, then they move back a little bit. Then they move up a little bit more, and then we get scared and they move down. I think it will be a herky-jerky local train, and it's going to be painful.
So you're saying that this is one of those classic 2 steps forward, in other words, 2 notches higher in interest rates and 1 step back.
Absolutely.
A lot of our viewers are sitting on bond investments, and they're sitting on very hefty profits. What do we do?
There was a stampede into bond funds right after the credit crisis. We saw more baby boomers put more money in exchange-traded bond funds, open-end, closed-ends, you name it, they invested in it. And so now they're all in. But behold, these same baby boomers have never had skin in the game in a bear market. So they think that they're safe and secure. During the
30 years of a bull market, the bond market.
So I think that it's prudent to take profits off of the table. Sell some or all of your long-term bond funds. I'm more worried about interest rate risk than I am credit quality risk, because the economy is doing pretty well, thank you very much. And I think that people, when we see interest rates go up another 50 basis points, another 100 basis points, are going to see...
Right, 0.5% or a full percent.
Yes, I think that those long-term bond funds, we're going to see massive losses, and that will not be good for the boomers who are either retired or looking to retire in a year or two.
Where else do we go? I mean, number one, as we just said, they have profits, so the total return on these bond funds has been pretty darn good. Where do you go to replace that kind of total return, capital appreciation, and the interest income?
You can't. Because we've had...
You're not going to replace it.
You're not. Look at, the last 2 years have been glorious years for emerging market debt, high yield debt, investment grade, and these are bonds, Consuelo. They have maturity dates, so they can only sell at certain premiums, and then those bonds start to get closer and closer to maturity, and then they're called and mature. So I think people have to lower their expectations and really have more of a fallout shelter type of mentality. If they go with my theme that interest rates have got no place to go but up, it's just a matter of, over what period of time they need to preserve their capital. They're not going to have a total return like we've seen the last 2 years. It was great, but it is over. And acknowledging that it's over is part of the problem. People want to hope and pray that things will turn around. So that's why I'm in the profit-taking mode. Now, certainly you have to think of the tail risk. If something... And
explain what the tail risk is.
Well, it means, those outliers that could happen. What happened in Japan?
Right.
Who knew? We didn't know. Anything like the Middle East, what's going on in the Middle East, nobody was prepared for that. So tail risk is something that could push yields down and prices up, but I think it will be for only a very, very short period of time. And therein goes my analogy of the train. It's a local. It stops and then starts again, and that's what I think is in store for us.
As you know, Bill Gross recently came out and said that he was have zero tolerance for treasuries. What's your position on treasury debt, and does it have any place in individuals' portfolios?
I'm right with Bill.
Point?
I don't think there's any value in treasuries, and I think if people want the safe haven, that's one thing. If they want a return on their money, that's another thing. I'm not worried about the financial system imploding like it did in 2008. I think we're pretty much past that, and there are other type of spread products, meaning corporate bonds, et cetera, that you can buy pretty much with impunity. There's good quality companies out there that have a lot of cash on their balance sheet and are doing very well. But treasuries, a 10-year treasury at 3.35%, not for my money, that's for sure.
Most people talk about a bond's maturity when it matures, when the actual underlying bond matures and you get your principal back. Then there's something called duration. What is duration, and why is it something that we as bond investors need to think about?
Good question. Okay, first of all, most individual investors think duration means maturity.
Right,
it does
maturity,
not.
Right.
It does not. Duration it has a couple of meanings. Both are very important. One of the meanings is how many years it'll take you to get your money back on a discounted cash flow basis. The cash flow comes from the coupons. An equally important part of the definition is how sensitive will your bond or your bond portfolio be to interest rate moves. So if you have a duration of 3 years, your corporate bond probably is about 5.5 years till maturity because you're getting those cash flows. If it's a 3-year duration and interest rates move up 1% immediately, that bond will go down 3%. Not the end of the world, but because you can see the light at the end of the tunnel because the maturity is coming around the corner. But if you have a longer term, 15 or 18-year duration, and interest rates go up 1%, being down 18% in a bond is pretty devastating.
So it's kind of it's a trade-off. For every rise in interest rates, you lose whatever that duration is. So if it's a 5-year duration in a bond and interest rates go up 1%, you actually lose 5% in your principal?
That's correct, on paper. Now, obviously, It's not a real loss until you sell it. But let's go back to the bond funds. Those bond funds have no maturity. They're in perpetuity. So the bond funds, people get scared, they get freaked out, and they go, oh my gosh, I'm down 15%, I'm down 18%, and then they sell. So you've got risk as far as redemptions are concerned, other people redeeming their money in the funds, whereas you think that you're going to sit and stay and wait it out. If I'm right that this 30-year bull market is over, you're going to wait for a long time. Most of us don't have another 30 years to wait.
From your perspective as a bond manager, of course, you purchase individual bonds for clients, correct?
I do, but I can buy open-end funds, closed-end funds,
Right.
ETFs. I think the individual bonds are the way to go now.
Right, for the reasons that you just mentioned. So you think that bond funds can be dangerous for a couple of reasons. And so just tell us why you should really look hard at the bond funds and actually consider buying individual bonds instead now.
Okay, first of all, you've got interest rate risk. The longer term the bond fund, the more interest rate risk you have, and you've got redemption risk. You may want to stay in the bond fund forever, but not everybody is in that same boat. And I'm not anti-bond fund, I'm just anti-long-term bond fund. If people have a small amount of money, $50,000, $100,000, and they can't buy a portfolio of bonds, then bond funds serve them very well, but they don't have to be in the long end. They could go into the intermediate and ultra short end, and then they've got kind of like a barbell in which their duration or sensitivity to the bond market is kind of like 3 or 4 years. So they're doing a surrogate kind of portfolio that people with a lot of money are doing with individual bonds.
What kind of a bond fund, when you said ultra short or intermediate term, I mean, do you think that corporate credits, for instance, corporate bonds, or would you go into government, GSEs, for instance?
Corporate bonds all the way.
Corporate bonds all the way.
I would, because
So investment credit, I mean, what's the reason?
There's so much cash on the corporation's balance sheet. During the credit crisis, CEOs did the right thing at the right time. They sliced back, cut back everything. They redid their balance sheets. They paid off long-term debt. They paid off high coupon debt. And we're sitting with non-financials about $2 trillion in cash. Now, mind you, they are starting to increase their dividend payments. They are
Which from a bond investor's point of view is a bad thing, right? Because you want the cash on the balance sheet.
Exactly.
You want that security.
And they're doing mergers and acquisitions,
Right.
but not so much with all debt. They're doing it with cash and stock. So I still think it's pretty much of a safe haven. I mean, obviously there's some companies that are doing a better job than others, but overall I really still like the corporate bond space. I think it's a very sweet space right now because of the way the CEOs are acting.
Municipal bonds. And you wrote a report that you sent out to your clients recently, and it was titled "Thank You, Meredith Whitney," talking about the analyst who went on 60 Minutes and basically warned about the financial straits that a lot of municipalities were in. Right now, what is your analysis then of investing in municipal bonds?
I think you do it very carefully. You don't throw the baby out with the bathwater. There are still some states that are in good shape. There are some individual municipalities that are, but you cannot be all in and not know what you own. And I do say, don't look at the historic numbers, because we have never had such large unfunded pension liabilities. We have never had such huge deficits. We have never been in this situation. So the historic numbers to me don't matter. I think the people that say that are just protecting their book of business because they want more business. That's pretty disingenuous. We are in a new paradigm shift here.
Does the same rule apply to municipal bonds as it does to regular bonds, that you're saying basically beware of a lot of bond funds? Do you think that we should go back to the days where we're used to of buying individual municipal bonds?
I think you can do that pretty safely if you do your homework. Mm-hmm. First of all, you buy municipal bonds in which they issue their financials yearly. A lot of them don't. You buy municipal bonds in which they are not only essential services like water and sewer revenue bonds, but things that everybody needs, like airports, like irrigation systems. Everybody does not need parking structures. Everybody does not need hockey rinks and stadiums. I mean, some of the bonds that have been issued throughout the years should have never gone under the municipal umbrella. So I think you can be very safe. You buy GOs from states whose deficits are not as large as.
Such as?
Virginia, Tennessee. You can buy permanent school fund bonds out of Texas that have really good assets behind them and guarantees. I'm not saying it's easy, Consuelo. I am saying it is a lot of work, but they are out there. And if you pick and choose and don't concentrate in your state, but you spread it out, I think you'll be okay.
What about pre-refunded munis, which you've talked about in the past as well?
Love them. Those are bonds. Old bonds that were issued anywhere between 15 to 25 years ago, and they can't call them in until their next call date. So what the municipality does is refinances them, just like people refinanced their homes a few years ago, refinances them, and then they set up an escrow account, and they take that money that they have refunded, and they put it in an escrow account, and they buy Treasury securities, specific Treasury securities that the Treasury issues for them. And so you are no longer worried about or contingent on making sure that the issuer makes the interest payments. It's the escrow account that is passing through the timely interest and principal payments. And I'm so glad you asked this question, because here's where the retail do-it-yourself investor has a big edge over the institution. The deals are in the $25,000, the $35,000, and the $50,000 amounts.
Which is perfect for individuals,
Absolutely.
right, not for institutions.
So what you can get is you can get a 1% due in 2012. You can probably get 1.20 in 2013. I get it. You're not going to get rich from that, but it's better than 1 basis point in a tax-free money market. And if, as an institution, if I were to buy 1 million of those bonds, my yield is 0.5% lower, 50 basis points lower. So I would only get 50 basis points in 2012. Great way to park your money, sit and use it kind of like your fallout shelter to see what's going to happen in muni land.
You know, I was surprised in reading some of your research, considering the fact that you think that interest rates are going higher, and that one of the reasons is that inflation is going to go higher. And yet you do not have a blanket recommendation to buy TIPS, Treasury Inflation Protected Securities. Why are you so cautious about TIPS? What should we know about TIPS that we should be aware of?
It isn't that I'm so cautious about TIPS, it's that I like SIPs better than TIPS, and those are the corporate inflation protected bonds. They're a different animal than TIPS. TIPS, you have to wait till you either sell the bonds or until they mature to get that CPI component. Well, with corporate inflation protected bonds, you get that CPI component monthly with your coupon. And the key to the bond market is how you reinvest your income stream. So you've got real cash, real increases in the CPI as it continues to go up, and you can reinvest it in other things. It's not a perfect thing to hedge yourself for inflation, either are TIPS, but it's the best we've got. So I would prefer the SIPs. There's one caveat. Most all of them are issued by the financial institutions. So you don't want 40% of your portfolio in those. You want maybe a maximum of 15%, but it's cash that you can spend immediately and reinvest, whereas with the TIPS you have to wait.
Your new book, Surviving the Bond Bear Market, Bondland's Nuclear Winter, which is certainly an attention getter. How long and how deep do you think the bear bond market's going to be? I
think it could be anywhere as short as a year and as long as 2.5 years.
Only? Oh, I was expecting this to be like a 30-year trend or something.
I don't think so, because I think once we get momentum, it'll really start chugging along. And I think, you reach inflection points in the bond market. And I think once we reach that inflection point, and look at the interest on the U.S. debt is 2.2%. The average interest over the last 30 years was 6%. We will revert back to that mean, and if we don't quite get there, it'll be close. And so I think that once it starts moving in action, if Congress doesn't act quickly, which they never do.
On deficit reduction.
Exactly. Deficit reduction is really the key here. I think that it could really speed up, and it will be bloody and awful, and then boom, it'll be over. Now, I don't think it's going to be a 30-year. I think maybe 2.5 years, but it's really dependent on Congress. It's in their hands.
So how do we survive it? Is this, here you are a bond manager, are you just going to take all of your clients out of the bond market for the next couple of years and just let what happens happen and then get them back in? I mean, how do we survive it as investors?
Well, no, I'm not going to do that, because my clients need the income to live on. And what you do, and what I have done, is shorten my duration, shorten my sensitivity to interest rates. The average corporate bond portfolio that I manage now has about a 3-year duration. Munis around 3.5 years. So I was longer in my duration when interest rates looked like they were going to go down. Now I'm shortening it up. I'm sacrificing yield today for opportunities somewhere down the road.
One investment recommendation for a long-term diversified portfolio, what would you have each of us own?
CIT-financed bonds. Yes, it's a finance company.
That had a lot of problems. John Thane is now the CEO.
Yes, and a lot of people lost a lot of money with CIT, because when we were doing the Bailout America gig, everybody thought CIT would be bailed out by the government, and it wasn't. CIT has gone into bankruptcy and out of bankruptcy, and you named the secret weapon, and that is John Thane. He is a CEO, chairman that has, you haven't heard from him. He was out there a bit bigger than life when he was with Merrill Lynch, and and
head of the New York Stock Exchange.
Yes, yes, and he was the fair-haired guy, and now he is looking for redemption. So there's nothing better than having a CEO running a finance company looking for redemption.
So Marilyn Cohen, such a treat to have you on Wealth Track. And you are the founder and CEO of Envision Capital Management, and you're also the author of a brand new book, which is going to be published very soon in the U.S., and it's called Surviving the Bond Bear Market. Great to have you on Wealth Track.
Thank you, my privilege.
Incidentally, for those of you who like to manage your own bond portfolio, Marilyn's book gives you access to a free electronic workbook with analytical capabilities usually available only to the pros. I hope you can join us next week. I'm going to be interviewing financial thought leader James Grant. The noted historian, author, columnist, and publisher of Grant's Interest Rate Observer is a sharp critic of the U.S. government's fiscal and monetary policy. He'll tell us how we as investors can protect ourselves from policies out of our control. And starting on Monday in our Wealth Track Extra feature on our website, wealthtrack.com, we will have an audio podcast with one of the country's top wealth advisors, Region Atlantic's Capital's Chris Cordero. He has some very useful last-minute tax tips for us. And on that note, we will conclude this edition of Wealth Track. Thank you so much for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Luma Sales, investors seeking exceptional opportunities globally. Research affiliates, an efficient index for an inefficient market. Wintergreen, your home for global value. Rosalind P. Walter and the Dreamin' Foundation.